Hey everyone, today I'll be explaining time frames and market trends in a simple and easy to understand way. By the end of this video, you'll have a clear understanding of the different time frames and how to easily determine market trends. Let's get started. First, let's talk about time frames, the specific periods you choose to analyze charts and make trading decisions. Imagine looking at a candlestick chart. Each candlestick represents a set amount of time, whether it's 1 minute, 1 hour, 1 day, or even 1 week. The time frame you select determines how much data each candlestick represents and plays a vital role in shaping your analysis and trading strategy. For example, on the screen, you can see a monthly time frame where each candlestick shows the price movement for an entire month. That's what we call time frames in trading. Short time frames like 1 minute or 5 minute charts show you the price action up close and personal. On the other hand, longer time frames like daily or weekly charts give you the big picture, smoothing out the noise of those minute-by-minute fluctuations. Think of it like this. A 1-minute chart is like looking at the stock market through a microscope, while a weekly chart is like looking at it from a satellite. Both perspectives offer valuable information, but the insights they provide are very different. For adrenaline junkies and those who thrive on quick profits, short-term time frames are the name of the game. Scalpers, as we call them, live and breathe these short-term charts. They're looking for tiny price fluctuations, buying and selling in rapid succession to scalp a few pips here and there. It's all about speed and precision, like a surgeon wielding a scalpel. But beware, my friends, short-term trading is not for the faint of heart. It requires nerves of steel, lightning-fast reflexes, and a high tolerance for risk. One wrong move and your profits can vanish faster than you can say margin call. Now, if you prefer a more laid-back approach to trading, long-term time frames might be your cup of tea. We're talking about swing traders and investors who hold their positions for days, weeks, or even months. They're not bothered by the daily noise of the market. They're focused on the bigger picture, identifying major trends and riding the waves to potentially bigger profits. Long-term trading is like sailing a ship across the ocean. You need to chart your course carefully, adjust your sails to the prevailing winds, and be prepared for the occasional storm. But with patience and discipline, you can reach your destination and reap the rewards. No matter your trading style, understanding time frames is crucial for identifying trends in the market. Trends are like ocean currents, carrying prices higher or lower over time. Shorter time frames can help you spot those early shifts in momentum, like a surfer catching a wave just as it's forming. But be careful. Not all waves are created equal. Some fizzle out quickly, while others gain strength and become powerful trends. That's where longer time frames come in handy. By analyzing daily or weekly charts, you can filter out the noise of the shorter-term fluctuations and identify those sustainable trends with greater accuracy. Section 5. Bull versus bear navigating different market conditions. Just like the animal kingdom, the stock market has its own predators, bulls and bears. Bull markets are characterized by optimism, rising prices, and a general sense of euphoria. Think of it as a party where everyone's buying and prices keep going up. On the other hand, bear markets are marked by pessimism, falling prices, and a general sense of fear. It's like someone just yelled fire in a crowded theater, and everyone's rushing for the exits, driving prices lower. Knowing whether you're in a bull or bear market is crucial for adapting your trading strategies. In a bull market, you might be more inclined to buy and hold, riding the wave of optimism higher. But in a bear market, caution is key. Section 6. Adapting strategies to market trends and time frames. A savvy trader knows that adapting their strategies to different market conditions and time frames is essential for success. During a bull market, when prices are soaring, you might use shorter time frames to capitalize on quick price swings. But when the bears are in control and fear grips the market, switching to longer time frames can help you weather the storm and identify potential buying opportunities amid the chaos. Remember, flexibility is key in trading. Don't be afraid to adjust your sails, change your time frames, and adapt your strategies as market conditions dictate. Section 7. Practical tips for mastering time frames. So how do you master the art of time frames in trading? Here are a few practical tips to get you started. 1. Start with a longer time frame. Begin your analysis by looking at daily or weekly charts to get a sense of the overall trend. 2. Drill down to shorter time frames. Once you've identified the trend on the higher time frame, use shorter time frames to pinpoint entry and exit points. 3. Use multiple time frames. Don't rely on just one time frame. Combine different time frames to confirm your analysis and increase your trading edge. And finally, practice, practice, practice. Like any skill, mastering time frames takes time and practice. Use a demo account to experiment with different time frames and find what works best for you. Section 8. The power of multiple time frames. One of the most powerful techniques in trading is using multiple time frames to confirm your signals and increase your odds of success. It's like having a team of analysts working for you, each providing a different perspective on the market. For example, you might identify a bullish trend on the daily chart, then switch to the hourly chart to find a pullback or consolidation phase. This pullback could present a low-risk entry point to ride the trend higher. By combining the insights from both time frames, you've essentially confirmed the bullish trend on a broader scale and identified a precise entry point on a shorter time frame. Section 9. Conclusion. Mastering time frames is like having the keys to the trading kingdom. It unlocks a deeper understanding of market trends, risk management, and strategic planning. By choosing the right time frames for your trading style and adapting to different market conditions, you can increase your odds of success in the exciting world of trading. Remember, the journey to trading mastery is a marathon, not a sprint. So keep learning, keep practicing, and never stop exploring the endless possibilities of time frames in trading. If you enjoyed this video, be sure to check out our other videos. You're going to love them too. As always, thank you for your support.